Welcome to a deep dive into the world of Kenyan employee benefits, specifically how they're taxed. We're going to be exploring how things like housing, insurance premiums, club memberships, and even loans can impact an employee's tax liability in Kenya, and more importantly, uncover some clever ways to optimize these benefits. Our main source for today is going to be this document creatively titled Pasted Text, and we're going to be focusing on pages 30 to 43. Get ready for some surprising exemptions, and even a special rule for employees living on plantations.
Yeah, it's fascinating how these benefits designed to attract and retain talent can sometimes create a bit of a tax puzzle. But understanding these nuances is crucial for companies operating in Kenya, especially when it comes to structuring competitive benefits packages while staying tax compliant.
Okay, let's unpack this. First up, housing. Now, you might think if a company provides you with a place to live, it's a sweet deal. No strings attached. Not quite. In Kenya, the value of that housing is actually added to your income and taxed accordingly. But here's the catch. The way this benefit is valued can change depending on your role within the company.
That's right. The method of calculating the taxable benefit is different for, say, a director compared to an agricultural employee living on a plantation, for instance. Let's take a hypothetical employee earning 3 million Kenyan shillings, if they're a director. Their taxable benefit for housing could be as high as 600,000 shillings.
Whoa, that's a sizable chunk of their income. How is that 600,000 shillings figure even calculated?
Well, it's the highest of three options. 15% of their income excluding housing, the market rental value of the house, or the rent the employer actually pays. In this case, it seems the market value or the rent paid by the employer hits that 600,000 shilling mark.
So for a director, a company-provided house could actually end up costing them more in taxes. But what about those agricultural employees living on plantations? You mentioned they have different rules.
Yes, their situation is unique. The Kenyan tax code acknowledges the specific circumstances of these employees, who often live on the plantation as a condition of their employment. So instead of the potentially complex calculations used for directors, the taxable benefit for these employees is simply 10% of their employment income.
So in our hypothetical example, an agricultural employee earning 3 million shillings would only have a 300,000 shilling taxable benefit for housing, half of what a director might face. This seems like a huge difference. Why such a significant discrepancy? Are there any downsides to this approach?
It's a great question, and highlights how seemingly straightforward benefits can have these layered implications. You're right, the difference is substantial, and it reflects the tax code's attempt to address the realities of different employment situations. Whether there are unintended consequences or potential drawbacks is a debate for policymakers, but at its core, it aims to provide a more equitable approach to taxing this benefit.
This definitely highlights the need to understand the nuances of the tax code. It seems like companies could even use this to their advantage when structuring benefits packages, right?
Absolutely. For example, a company might consider offering housing on agricultural properties to utilize that lower 10% rule for eligible employees. It's all about thinking strategically and finding creative solutions that benefit both the company and its employees.
So it's not just about understanding the rules, but knowing how to apply them strategically. Now, I'm curious about other benefits. What about things like insurance premiums? If my employer is kind enough to cover those costs, are there any tax implications I need to be aware of?
Generally, if your company pays for your life insurance premiums, that amount is added to your income and taxed. It makes sense. It's essentially another form of compensation. However, there are key exceptions. Premiums paid towards registered pension schemes or pension funds are not considered taxable income. And the same goes for group life policies that don't directly benefit you or your dependents.
So companies can help their employees save for retirement and provide life insurance coverage without increasing their tax burden. It's a win-win.
Well,
But I'm guessing it's not always that simple. What about those fancy club memberships some companies offer?
unfortunately, those perks are usually a different story. Any entrance or subscription fees your company pays for you to join a club are considered taxable income. No escaping the tax man on that one.
That makes sense. It's basically like receiving extra cash. But then wouldn't it be smarter for companies to invest in employee well-being programs instead of those taxable club memberships?
Now you're thinking like a tax optimization pro, offering things like on-site fitness facilities